There is a ghost in the machine of the global economy. It is a phantom that whispers in the ear of every CEO, every day trader, every person saving for retirement. It is the architect of euphoria and the harbinger of despair. It is the ceaseless, frantic, digital pulse of the stock market. We watch its daily movements with a kind of religious fervor, interpreting its green upticks as signs of favor and its red downticks as omens of ruin. We have been taught, by culture and by instinct, to see this ticker tape as a measure of truth, a real-time report card on our wealth, our decisions, our very future. But what if this entire belief system is a catastrophic lie? What if the daily noise of the market is not a guide to be followed, but a madness to be exploited? What if the very thing that most people see as a source of information is, in fact, the single greatest source of financial self-destruction? There is one man who solved this riddle decades ago. A man who built an empire of staggering proportions, not by predicting the market's movements, but by fundamentally rejecting their significance. Warren Buffett, the chairman of Berkshire Hathaway, did not create his fortune with a complex algorithm or a secret source of information. He did it with a story, a simple parable, a mental model so powerful it can immunize the mind against the twin poisons of greed and fear. He calls it the story of Mr. Market. This story is the key. It is the operating system for a rational mind in an irrational world, the definitive antidote to the emotional volatility that causes the vast majority of investors to buy at the peak of optimism and sell at the bottom of despair, perpetually destroying their own chances at long-term investing success and true wealth creation. The thesis is this: the market is not a measure of value, it is a manic depressive business partner whose mood swings offer you opportunity, not instruction. Your job is not to listen to his ravings, but to patiently wait for his moments of madness, and then act with cold, calculated reason. He is your servant, not your master. Understanding this single concept is the dividing line between amateur speculation and professional capital management. It is the final promise of emotional control in an arena designed to provoke emotional chaos. Today, we are not just going to tell you the story of Mr. Market. We are going to deconstruct it piece by piece and rebuild it inside your own mind as a permanent fixture of your decision-making process. We will explore the 5 fundamental pillars that support this fortress of reason, turning a simple allegory into a detailed blueprint for financial freedom. This is not just financial education. This is the installation of a new mental operating system. Our first pillar is the bedrock upon which everything else is built. It is the parable itself, the foundational act of separating the fleeting hysterical price of an asset from its durable, underlying value. To truly understand this, we must go back not to Buffett, but to his mentor, the father of value investing himself, Benjamin Graham. For it was in the hallowed pages of his 1949 masterpiece, The Intelligent Investor, that the character of Mr. Market was born. Buffett has called this the greatest book on investing ever written, specifically citing Chapter 8 as the source of the idea that gave him the framework for a lifetime of success. Imagine yourself as an investor in the post-war boom. The world is rebuilding, industries are roaring back to life, and the siren song of the stock market is pulling in a new generation of participants. For them, the ticker was a living entity, a source of wisdom. But Graham, a man who had lived through the unbridled insanity of the 1920s and the soul-crushing despair of the Great Depression, knew better. He knew the market had a personality, and it was dangerously unstable. So he created an allegory. He asked his readers to imagine they were in a private business partnership with a man named Mr. Market. He is a very accommodating partner. Every single day, without fail, he comes to you and tells you what he thinks your shares in the business are worth. And, what's more, he offers to either buy your shares from you or sell you his shares at that exact price. But Mr. Market has a serious emotional problem. He is a manic depressive. Some days, he shows up at your door overcome with incredible optimism. He sees nothing but blue skies ahead for the business and the world. On these days, he quotes a ridiculously high price for your shares. His euphoria is infectious. and the price he offers seems to validate the idea that you are a genius for owning a piece of this wonderful enterprise. Then there are other days. On these days, Mr. Market is inconsolable. He is paralyzed by pessimism, convinced that the business and the world are headed for immediate and irreversible disaster. On these days, he quotes a price so low it feels like an insult. He is desperate to get out, to sell his stake to you for pennies on the dollar before the coming apocalypse. The most important part of this partnership, Graham explained, is this: Mr. Market does not mind if you ignore him. He will be back tomorrow with a new quote, driven by a new mood. He is a servant, there to offer you a price. He is not a master, there to tell you the truth. Your job as an intelligent investor is not to be influenced by his daily mood swings. Your job is to have your own, independently researched opinion of what the business is actually worth, its intrinsic value. If his manic optimism leads him to offer you a price far, far above your calculation of the business's value, you should be delighted to sell your shares to him. If his crippling depression leads him to offer to sell you his shares at a price far, far below your calculation of value, you should be thrilled to buy from him. And if his daily price is nowhere near your calculation of value, you do nothing. You simply go about your day, confident in your own analysis, knowing he will be back tomorrow with another, perhaps more interesting, offer. This simple story was a revolution in investor mindset. It created a psychological buffer between the investor and the madness of the crowd. Warren Buffett didn't just read this, he absorbed it into his DNA. It became the central pillar of his entire approach to capital management. One of the most telling anecdotes of this principle in action is his 1964 acquisition of American Express. This wasn't a simple stock purchase, it was a masterclass in separating a company's temporary, headline-driven price from its long-term, franchise value. The story begins with the salad oil scandal. A small, insignificant company in New Jersey called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, had perpetrated one of the greatest frauds in modern financial history. DeAngelis had discovered he could get loans using his vast inventory of salad oil as collateral. The problem was, he didn't have nearly as much salad oil as he claimed. His scam was deviously simple. He would fill his massive storage tanks mostly with water, with only a thin layer of oil floating on top. When inspectors came, they would measure the oil from the top, believe the tanks were full, and approve the loans. American Express was caught in the middle because its warehousing subsidiary had issued receipts vouching for DeAngelis's non-existent oil. When the fraud was discovered in November 1963, Allied Crude went bankrupt, and its lenders, holding worthless warehouse receipts from American Express, demanded to be made whole. The market panicked. The question on every investor's lips was whether American Express, the parent company, was legally on the hook for the massive losses of its subsidiary. Wall Street's verdict was swift and brutal. Mr. Market, in a fit of profound terror, decided that American Express was facing a cataclysmic, potentially fatal liability. The stock, which had been trading around $65 a share, was eviscerated. It plummeted by nearly 50%, down to $35 a share. This was the moment of maximum pessimism. The headlines were filled with doom, and the prevailing wisdom was that this venerable company, a symbol of American financial stability, was teetering on the brink of insolvency. This is where the 99% of investors follow Mr. Market off the cliff. They hear the noise, they see the terrifying red numbers, they read the apocalyptic headlines, and they sell. They capitulate to the fear. But Warren Buffett, armed with Graham's parable, did the exact opposite. He saw Mr. Market's panic not as a signal of truth, but as a signal of opportunity. He didn't ask, "What is everyone else saying?" He asked a different, more fundamental question. Is the underlying business of American Express still valuable? He ignored the price and focused on the value. So he did his own research, his own scuttlebutt investigation. He didn't just look at balance sheets, he went out into the real world. He visited restaurants and hotels. He talked to bank tellers. He wanted to see if the scandal had damaged the core businesses that made American Express great, its travelers' checks and its charge card. What he found was that the public's trust in the brand was unshaken. People were still using the traveler's checks. Businesses were still happily accepting the American Express card. The scandal was a Wall Street story, a legal and financial problem, but it hadn't touched the deep, competitive moat of the actual business. The customers didn't care about salad oil. They cared that their card worked and their checks were trusted. Buffett concluded that the long-term earning power of the American Express franchise was intact. The legal liability, while serious, was a one-time hit that the company could easily survive. Mr. Market, in his panic, was confusing a temporary survivable problem with a permanent, fatal one. He was offering to sell shares in a wonderful, world-class business for a fraction of its true worth simply because of a scary headline. So Buffett acted. Between 1964 and 1966, his investment partnership aggressively bought American Express stock, eventually investing 40% of the partnership's assets, a $13 million bet. It was a massive, highly concentrated investment. Within a few years, as the company settled, the legal claims and its powerful earnings engine continued to churn. The market's mood swung from despair back to optimism. The stock price soared, and Buffett's partnership made a fortune. He didn't predict this. He simply recognized that Mr. Market was offering him a bargain and had the courage to accept it. This is the parable in action. It is the core of value investing and the foundational discipline for any serious approach to wealth building. The psychological principle that makes the Mr. Market allegory so powerful is its direct assault on two of the most potent cognitive biases that plague human decision-making: the anchoring effect and the framing effect. These mental shortcuts, while useful in our evolutionary past, are catastrophic in the world of modern finance. Mastering them is a cornerstone of behavioral finance and essential for developing a true CEO mindset. First, let's look at the anchoring effect. This bias describes our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In investing, the most prominent and seductive anchor is the current stock price. When you look up a company, the first thing you see is its price. That number immediately lodges itself in your brain. Subsequent judgments and analysis are all made in relation to that initial anchor. If a stock is trading at $500 and it drops to $400, our brain, anchored to the $500 price, screams, "It's on sale!" If it goes to $600, our brain screams, "It's winning!" We rarely stop to ask the most important question. Is the initial anchor of $500 even remotely connected to the actual value of the underlying business? Mr. Market is the ultimate purveyor of false anchors. Every day, he presents you with a new one. The ticker tape is a constant stream of anchors, designed to pull your focus away from your own independent analysis. The average person's entire investment strategy is dictated by these anchors. They see a stock that is run up from $10 to $100 and anchor to the $100 price, believing it's a winner and piling in at the top, a classic mistake of emotional investing. Conversely, they see a stock fall from 100 to 50 and anchor to the old high, thinking it has to go back up, without ever analyzing if the fundamental business has deteriorated. Buffett's use of the Mr. Market allegory is a conscious act of de-anchoring. The story trains your mind to see the daily quote not as an anchor of truth, but as the random, emotionally driven noise of your bipolar partner. Your anchor should not be the price Mr. Market gives you. Your anchor must be your own calculated estimate of intrinsic value. This is a profound mental shift. It requires you to do the hard work of building your own anchor based on earnings power, assets, and future prospects, and then holding on to it with iron conviction, regardless of where Mr. Market's daily quotes are flying. The second, and equally powerful, bias at play is the framing effect. This is a cognitive bias where people decide on options based on whether the options are presented with positive or negative connotations, for example, as a loss or as a gain. The way information is framed has a massive impact on our conclusions. The financial media is a master of framing. On a day when the market is up, the headlines are framed with words like rally, surge, optimism, and gains. The color is green. The connotation is positive. This frames your decision to buy as joining a winning team. On a day the market is down, the headlines use words like plunge, collapse, fear, and losses. The color is red. The connotation is negative. This frames your decision to sell as a prudent act of self-preservation, of escaping danger. Mr. Market is the ultimate framer. His manic moods frame his offers in the language of euphoria. His depressive moods frame his offers in the language of terror. The allegory teaches you to consciously reject his frame and apply your own. When Mr. Market is panicking and offering you shares at a low price, the media will frame this as catching a falling knife or investing in a disaster. The story of Mr. Market reframes it. It is not a disaster. It is a clearance sale. It is your manic depressive partner offering you a once-in-a-decade bargain. This reframing from a threat to an opportunity is the psychological superpower of the value investor. In the American Express salad oil scandal, the public frame was, quote, company on the brink of collapse. Buffett reframed it as world-class franchise with a temporary solvable problem now on sale. This ability to consciously reframe the narrative is not just a clever trick, it is a fundamental requirement for rational capital management. By personifying the market as an unreliable, emotional character, the allegory forces you to become skeptical of the frames he presents. It builds a mental firewall, allowing your rational brain to analyze the data on its own terms, free from the manipulative framing of headlines and crowd emotion. This is the essence of thinking like an owner of a business rather than a renter of a stock, a key principle for any entrepreneur or executive. So how do we translate this powerful theory into a practical, step-by-step process? How does an individual investor or entrepreneur build their own anchor and reframe the market's noise? This is the blueprint, the applied mental model for implementing the separation of price and value into your own financial life. The first step is to choose your arena. You cannot possibly calculate the intrinsic value of thousands of different companies. It's impossible. This is what Buffett calls the circle of competence. You must identify a handful of industries or business models that you can genuinely understand. Perhaps you work in software, so you have an edge in understanding tech companies. Perhaps you are a devoted consumer of a particular brand, giving you insight into its competitive strength. The goal is not to be an expert on everything, but to be a true expert on a few things. Make a list of no more than 10 to 15 companies that fall within this circle. These are the only businesses you will allow yourself to analyze. This immediately tunes out 99% of Mr. Market's daily noise. The second step is to build your anchor, the calculation of intrinsic value. This is the most crucial part of the process. For each company on your shortlist, you must build a case file, as if you were considering buying the entire business outright. You need to read at least the last 5 years of their annual reports. Pay close attention to the letter to shareholders from the CEO. This gives you insight into the quality of the management and their philosophy on capital management. You must analyze the numbers. Look for consistent growth in revenue and earnings. Look for high and stable profit margins and return on equity. These are signs of a durable competitive advantage, or what Buffett calls a moat. Most importantly, you need to project the company's future cash flows. A simple way to begin is to look at the owner earnings, which Buffett defines as net income plus depreciation and amortization, minus the average annual amount of capital expenditures needed to maintain the business. Can you reasonably project these earnings out over the next 10 years? A conservative estimate is all you need. Once you have a projection of future earnings, you can use a discounted cash flow (DCF) analysis to determine what those future earnings are worth in today's dollars. This calculation, your DCF value, becomes your anchor. It is your private, rational estimate of the company's true worth. The third step is to define your margin of safety. This concept, also from Benjamin Graham, is the cornerstone of risk management. You never buy a business at your exact estimate of its intrinsic value. Why? Because your projections could be wrong. The future is uncertain. The margin of safety is a discount you demand from your calculated value to protect yourself from errors and bad luck. A typical margin of safety might be 30 to 50%. So if your DCF analysis tells you that a business is worth $100 per share, You do not buy it at 95. You establish a buy price for yourself at, say, $65 or less. You write this number down. For each of the companies on your watch list, you now have a single, cold, hard number, the price at which you are willing to become an owner. The fourth and final step is the discipline of patience. You have your watch list, you have your calculated intrinsic values, you have your margin of safety buy prices. Now you do nothing. You go about your life. You let Mr. Market have his daily manic-depressive episodes. You can check his quotes once a day, or even once a week. Your only task is to compare his offer price to your predetermined buy price. Is he offering to sell you your target company at or below your number? If the answer is no, you ignore him and move on. You do not get tempted if the price gets close. You do not get frustrated if the price runs away from you. You stick to your numbers. But one day, perhaps during a market crash or a panic over a bad quarterly report, Mr. Market will be in a state of terror. He will offer you your wonderful company at a 50% discount to what you know it's worth. Because you have done the work beforehand, you will feel no fear. You will feel only excitement. This is the moment you have been waiting for. You will act decisively and buy, not because you are a genius predictor, but because you are a disciplined practitioner of a rational process. This is how you turn the tables and make the market your servant. To truly appreciate the power of this approach, we must dedicate some time to exploring its opposite, the path of the 99%. This is the world of the emotional investor, the individual who has unknowingly made Mr. Market their master, their guru, their god. Their experience of investing is not one of calm, rational analysis, but a white-knuckle roller coaster of extreme anxiety and fleeting euphoria. The antithesis begins with the complete fusion of price and value. To the average person, the price infers the value. A stock going up is a good stock. A stock going down is a bad stock. Their entire analysis consists of looking at the short-term price chart. This makes them profoundly susceptible to the mood of the crowd. They are not investing in a business. They are renting a ticker symbol, hoping it will go up. This leads to the disastrous behavior of buying high and selling low. Let's trace the journey. A particular sector, let's say technology, gets hot. The news is filled with stories of overnight millionaires. Mr. Market is in a state of pure mania. He is quoting higher and higher prices every day. The emotional investor, driven by a powerful fear of missing out (FOMO), sees the price chart going up and up. They see their neighbors getting rich. They can't stand it anymore. They abandon all logic and pile in near the top. They buy when the price is highest and the risk is greatest, precisely when their manic partner is offering them the worst possible deal. Then, inevitably, the bubble pops. The narrative shifts. The headlines turn from greed to fear. Mr. Market has a psychotic break and plummets into a deep depression. He quotes lower and lower prices every day. The emotional investor now sees their portfolio bleeding red. The pain of loss, which psychologists tell us is twice as powerful as the pleasure of gain, becomes unbearable. Gripped by terror and convinced the stock will go to zero, they sell. They capitulate at the point of maximum pessimism, locking in their losses and ensuring they miss the eventual recovery. They sell when the price is lowest and the opportunity is greatest, accepting the worst possible deal from their depressive partner. This is the cycle that destroys wealth. Year after year, generation after generation. This path is also characterized by hyperactivity. The emotional investor feels the need to do something all the time. They check their portfolio constantly. They listen to financial news pundits who are paid to create a sense of urgency and drama. They trade in and out of positions, racking up huge commission fees and taxes, mistaking activity for progress. They are perpetual victims of shiny object syndrome, chasing the latest hot trend, be it crypto, meme stocks, or speculative tech, without any understanding of the underlying asset. They are not engaged in a serious endeavor of capital management. They are playing a video game where the points are their life savings. The consequences are devastating, not just financially, but emotionally. Investing becomes a source of constant stress, a battle they can never win because they are fighting on the wrong battlefield. They are trying to outsmart Mr. Market at his own game, a game of short-term emotional guessing, instead of playing the one game they can win, the long-term game of owning great businesses purchased at sensible prices. The financial connection between Buffett's Mr. Market mindset and tangible wealth creation is direct, quantifiable, and massive. It manifests on the balance sheet of your life in several profound ways. First and foremost is the impact on your long-term compound annual growth rate, or CAGR. The single greatest determinant of your long-term return is the price you pay for an asset. By using the Mr. Market allegory to force yourself to buy only when prices are significantly below intrinsic value, you are dramatically juicing your future returns. Imagine two investors buying the same great company. Investor A buys during a bull market when Mr. Market is happy, paying $100 a share. Investor B, using the blueprint, waits for a market correction when Mr. Market is scared and buys the exact same company for $60 a share. Over the next 10 years, the company grows and its stock price reaches $300. Investor A has tripled their money, a handsome return. But Investor B has quintupled their money. Their patience and discipline, their ability to exploit Mr. Market's fear, resulted in a vastly superior financial outcome from the exact same underlying asset. This difference, compounded over an entire investment lifetime, is the difference between a comfortable retirement and generational wealth. Second, this mental model is the ultimate tool for risk management. The 99% think of risk as price volatility. A stock that moves around a lot is risky. Buffett defines risk in a completely different way. Risk is the permanent loss of capital. Buying a wonderful business at a silly price is extremely risky, even if the price is stable. Buying that same wonderful business at a 50% discount to its intrinsic value is extremely low risk, even if the price is volatile in the short term. The margin of safety is your shield. When you buy with a large margin of safety, you have a buffer against bad luck, analytical errors, or unforeseen business problems. If you calculated intrinsic value at $100 and bought at $60, the business can underperform your expectations significantly, and you can still make a decent return, or, at the very least, get your capital back. The emotional investor who buys at $150 has no such buffer. Any piece of bad news, any slight miss on quarterly earnings can lead to a permanent loss of their capital. This framework fundamentally reorients your entire perception of risk, moving it from short-term price jitters to the long-term probability of destroying your savings. This is the kind of risk management that separates Berkshire Hathaway from a speculative hedge fund. It is the foundation of durable wealth building. By separating price from value, you move from a gambler to an insurance actuary, stacking the odds in your favor for the long haul. We have established the foundation, the allegory of Mr. Market, which allows us to sever the dangerous link between an asset's price and its true value. Now we move to our second pillar, which is the practical application of this principle in a specific and terrifying environment, the market crash. This pillar is about exploiting fear, a deep dive into the psychology of buying when Mr. Market is at his most depressed, when the blood is in the streets. This is where fortunes are truly made. The ability to act with courage and clarity during a panic is perhaps the rarest and most valuable skill in all of finance. It is the ultimate test of an investor's mindset. Buffett's career is a living testament to this principle. While others see crashes as disasters, he sees them as once-in-a-generation investment opportunities. He is the master of being greedy when others are fearful. The foundational anecdote for this pillar is not a single transaction, but a period of profound crisis, the financial meltdown of 2008. The fall of that year was a moment of absolute, world-ending terror. The global financial system, built on a mountain of subprime mortgage debt and esoteric derivatives, was collapsing in on itself. Lehman Brothers, a 158-year-old institution, had vaporized over a weekend in September. AIG, the world's largest insurance company, was on government life support. The credit markets were frozen solid. It felt like the end of capitalism itself. Mr. Market was not just depressed. He was catatonic with fear, offering to sell entire industries for pennies on the dollar. The Dow Jones Industrial Average was in free fall, shedding thousands of points, erasing trillions of dollars in perceived wealth. The dominant emotion was not just fear, it was pure, unadulterated panic. The vast majority of people were stampeding for the exits, selling everything. Good stocks, bad stocks, it didn't matter, just to get to the perceived safety of cash. In the midst of this chaos, on October 16, 2008, Warren Buffett did something extraordinary. He published an op-ed in the New York Times titled, simply, "Buy American, I Am." It was a public declaration of war against the prevailing fear. He began the article with a clear and chilling statement. The financial world is a mess, both in the United States and abroad. Its problems, moreover, have been leaking into the general economy, and the leak is now turning into a gusher. He didn't sugarcoat the situation, he acknowledged the fear. But then, he deployed the logic of Mr. Market. He reminded people of a simple rule he follows. Be fearful when others are greedy, and be greedy only when others are fearful. He stated, in no uncertain terms, that the fear was now rampant, and that high-quality American businesses were on sale. He was explicitly telling the world that Mr. Market was offering a historic bargain. But Buffett didn't just talk. He acted, with the full force of Berkshire Hathaway's legendary balance sheet. He became the lender and investor of last resort to the titans of American industry. In September 2008, at the height of the panic, he invested $5 billion in Goldman Sachs, the premier investment bank on Wall Street. This wasn't a simple stock purchase. It was a brilliant piece of financial engineering. He bought $5 billion in preferred stock that paid him a staggering 10% annual dividend, $500 million a year guaranteed. He also received warrants to buy another $5 billion worth of common stock at a fixed price. It was an incredibly lucrative deal, a deal that only he could get, precisely because he was the only one with the capital and the courage to act when everyone else was paralyzed by fear. The investment was a massive psychological signal to the world that a sane and respected investor believed Goldman Sachs would survive. A few weeks later, he did it again, investing $3 billion in General Electric, another iconic American company whose financing arm was in jeopardy. And across the board, Berkshire Hathaway was buying common stocks of companies like Wells Fargo and American Express, which were being decimated in the market rout. While the 99% were selling in a panic, Buffett was on a shopping spree. He wasn't timing the bottom. In his op-ed, he freely admitted he had no idea if the market would go lower in the short term. He wrote, "I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, long before either sentiment or the economy turns up." He was focused not on the price, but on the long-term value. He knew that these great American businesses would eventually recover and thrive, and Mr. Market was offering him the chance to buy them at prices that made long-term success a near certainty. The results were spectacular. His Goldman Sachs investment alone netted Berkshire a profit of over $3 billion. His broader stock purchases made during the crisis formed the foundation for the next decade of Berkshire's incredible performance. He didn't have a crystal ball. He had a sound temperament and a mental model that allowed him to see opportunity where others saw only ruin. The psychological principle that Buffett masterfully leverages during a market crash is the inversion of loss aversion and herd mentality. These two biases, when combined, create a toxic feedback loop that fuels market panics and destroys amateur investors. Understanding how to break this loop is the key to unlocking the power of buying low. Loss aversion, a concept pioneered by psychologists Daniel Kahneman and Amos Tversky, describes a simple but profound feature of the human mind. The pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels as bad as gaining $200 feels good. This asymmetry is hardwired into our brains. In a market crash, this bias runs rampant. Investors don't see falling prices as a business getting cheaper. They see it as losing money. Every downward tick of their portfolio statement triggers that powerful, painful loss signal in their brain. The rational thought, "This is a great company now available at a more attractive price," is completely overwhelmed by the emotional scream, "I'm losing everything." This intense pain creates an overwhelming urge to stop the bleeding, to sell at any price, just to make the pain go away. This is why people capitulate at the bottom. It's not a financial decision, it's a neurological one. They are trying to medicate the pain of loss. Compounding this is herd mentality, also known as the bandwagon effect. Humans are social creatures. For millennia, our survival depended on sticking with the tribe. Going against the group was dangerous. This instinct is still deeply embedded in our psychology. When we see everyone around us running for the exit, our instinct is not to stop and analyze the situation. Our instinct is to run with them. In a financial panic, the herd is selling. The news, your friends, the so-called experts on television, everyone is screaming, "Sell!" The social proof is overwhelming. To stand against that tide, to be the person buying when everyone you know is selling, feels unnatural, foolish, and terrifyingly lonely. It feels like you are the one crazy person who doesn't see the fire that everyone else is fleeing from. The combination is lethal. Your own brain is screaming at you because of loss aversion, and the entire world around you is screaming at you because of herd mentality. This is the psychological vortex that creates a market bottom. Buffett's approach, guided by the Mr. Market allegory, is a conscious and deliberate inversion of these forces. He uses the herd not as a source of information, but as a contrary indicator. The more panicked the herd, the more excited he becomes. He has trained his mind to associate the herd's fear not with danger, but with opportunity. He has rewired his response. When the headlines are apocalyptic, his greed glands start to flow. Furthermore, he sidesteps loss aversion by fundamentally reframing the situation. He is not losing money when the price of a stock he owns goes down. He is simply being presented with an opportunity to buy more of a wonderful business at an even better price. Because his focus is on the long-term value of the business, not the short-term quotation of the stock, the price drop is a gift, not a threat. He is thinking like a business owner. If you owned a profitable local pizza parlor, and someone came to you in a panic and offered to sell you the equally profitable pizza parlor across the street for half of what it's worth, you wouldn't feel fear. You'd feel excitement. You would drain your bank account to make the purchase. By viewing stocks as ownership stakes in real businesses, Buffett adopts this owner's mindset, rendering him immune to the price-focused panic that cripples others. This is the essence of behavioral finance applied at a world-class level. So how can you build a system to exploit fear instead of succumbing to it? This is the blueprint for acting rationally during a market crash. It is a process that must be established during times of calm, so that it can be executed automatically during times of chaos. Step 1 is to create your shopping list well in advance. This goes back to the circle of competence. You should have a list of 10 to 15 great companies you'd love to own at the right price. For each one, you have already done the deep work. You've studied their business models, their competitive advantages, their management, and their financial health. Crucially, you have already calculated your estimate of their intrinsic value and determined your margin of safety by price. This list is your roadmap in the fog of war. When a crash happens, you are not trying to do complex analysis with a gun to your head. You are simply consulting the shopping list you made with a clear and rational mind. Step 2 is to accumulate cash and keep your powder dry. You cannot be greedy when others are fearful if you have no capital to deploy. A key part of the Buffett strategy is to always have a significant cash position. In the years leading up to 2008, Buffett was criticized for holding on to too much cash, for being too conservative as the bull market roared. But this cash is not idle. It is an option. It is the ammunition you need to take advantage of the extraordinary opportunities that market dislocations provide. For an individual investor, this means not being 100% invested all the time. It means having a dedicated portion of your portfolio in cash or short-term treasuries, waiting for Mr. Market to have his nervous breakdown. This requires immense patience and discipline, as you will underperform in the late stages of a bull market. You must be willing to look foolish in the short term to be brilliant in the long term. This is a core tenet of effective capital management. Step 3 is to deploy capital systematically, not all at once. Buffett never tries to time the absolute bottom, and neither should you. A market crash is a process, not a single event. A sound strategy is to deploy your cash in tranches. For example, once the market has fallen, say 20% from its high, you might deploy the first 25% of your cash into the top names on your shopping list that have hit their buy prices. If the market falls another 10%, you deploy the next tranche. This approach has two benefits. First, it gets you invested and allows you to take advantage of low prices. Second, it provides a psychological benefit. If the market continues to fall after your first purchase, you don't feel regret. You feel excitement because you still have cash ready to buy at even better prices. This systematic approach removes the impossible burden of trying to pick the perfect moment and replaces it with a rational process of averaging into great businesses at bargain prices. It's a strategy that embraces volatility instead of fearing it. This is how a sound financial advisor would structure a plan for a high net worth client facing a market crash. The path of the 99% during a market crash is a well-documented tragedy. It is the antithesis of this rational process and the primary driver of wealth destruction for the average person. Their journey begins with a complete lack of preparation. They have no watch list of great businesses. Their portfolio is a random assortment of hot stocks they bought on tips or momentum, with no understanding of their underlying value. They are fully invested, often with leverage, having been lulled into a sense of complacency by the long bull market. They have no cash reserves. When the crash begins, they are immediately caught off guard. Their first reaction is denial. It's just a healthy correction, they tell themselves. They anchor to the recent highs, convinced the market will bounce right back. They watch in disbelief as the market continues to slide. Then, denial gives way to fear. The headlines get scarier. Their portfolio value is shrinking at an alarming rate. Loss aversion kicks in with brutal force. They start having trouble sleeping. They are glued to the financial news, which only heightens their anxiety. Their conversations with friends are filled with panic and despair. The herd mentality takes over. They hear stories of people getting out to preserve capital. Their financial advisor, who is likely just as scared, might even recommend selling. The pressure becomes unbearable. Finally, they reach the point of capitulation. They can't take the pain anymore. They sell everything, often near the absolute bottom of the market. The immediate feeling is one of relief. The pain has stopped. But this relief is short-lived because they have just made the single worst financial mistake possible. They have turned a temporary paper loss into a permanent, real loss of capital. But the tragedy doesn't end there. Having sold at the bottom, they are now sitting in cash, traumatized by the experience. As the market inevitably begins its slow, uncertain recovery, they are too scared to get back in. It's a dead cat bounce, they say. The other shoe is about to drop. They wait for a better entry point, for the certainty that the recovery is real. But that certainty never comes. The market recovers on a wall of worry. By the time the economy is clearly improving and the headlines are positive again, the market has already recovered most of its losses. They finally feel safe enough to get back in, buying back the same assets they sold in a panic, but now at a much higher price. They successfully managed to sell low and buy high, the perfect recipe for financial ruin. This cycle, repeated over and over, is why the average investor's returns consistently and dramatically underperform the market averages. They are not victims of the market. They are victims of their own uncontrolled emotions. The direct financial connection of being able to exploit fear is nothing short of life-changing. It is the rocket fuel for long-term wealth creation. First, buying during a market crash dramatically lowers your portfolio's overall cost basis. This means that for every dollar of future earnings a company generates, a much larger portion of it accrues to you as a return on your investment. A lower cost basis is like getting a permanent head start in a race. It magnifies all future gains. This is a concept any entrepreneur who has raised capital understands intimately. Getting in on the seed round valuation is infinitely more profitable than getting in on the pre-IPO valuation. A market crash allows the public investor to get seed round-like entry points on established, world-class businesses. Second, it allows you to buy future income streams at exceptionally high yields. When the price of a dividend-paying stock falls, its dividend yield goes up. In the depths of 2008 and 2009, it was possible to buy shares in blue-chip companies paying safe, sustainable dividends yielding 4, 5, or even 6%. By buying at these moments, you are locking in a high passive income stream for years or even decades to come. As the company recovers and grows its dividend, your yield on your original cost can become astronomical. An investor who bought Johnson & Johnson during the panic might now be enjoying a yield on cost of over 10%. This is a powerful engine for achieving financial freedom, as your portfolio begins to generate a significant and growing stream of cash flow that can support your lifestyle. Finally, and most powerfully, acting rationally during a crash gives you an insurmountable mathematical advantage. A portfolio that falls by 50% requires a 100% gain just to get back to even. The damage from large drawdowns is geometrically devastating. By avoiding the panicked selling at the bottom, you preserve your capital base, allowing it to recover and compound. And by actively deploying cash at the bottom, you are pouring fuel on the fire of the recovery. The returns you can make from the bottom of a bear market are often several years worth of normal bull market returns compressed into a short period. Capturing even one or two of these cycles in your investment lifetime can be the single greatest determinant of your ultimate financial success. It is the ultimate reward for mastering the psychology of Mr. Market's deepest depression. We have now explored how to behave when Mr. Market is in the depths of despair. Our third pillar addresses the opposite and in many ways more seductive challenge. Resisting euphoria. This is the discipline of selling, or more often, not buying, when Mr. Market is in a state of manic ecstasy. If the crash is a test of courage, the bubble is a test of discipline and humility. The siren song of easy money and soaring prices can lure even the most sensible investors into ruinous decisions. Buffett's ability to remain rational while the world around him loses its mind to greed is just as important to his success as his ability to act during a panic. The quintessential foundational anecdote for this pillar is Warren Buffett's famous refusal to participate in the dot-com bubble of the late 1990s. It is impossible to overstate the atmosphere of that time. The internet was new, exciting, and promised to change everything. A new paradigm of business had apparently been born, one where old metrics like profits and revenues were irrelevant. All that mattered was eyeballs, growth, and a good story. Companies with no earnings, no profits, and sometimes no viable business model were going public and seeing their stock prices multiply overnight. It was a nationwide frenzy. Tech stocks were the only conversation at cocktail parties. Cab drivers were giving stock tips. It seemed like a foolproof way to get rich quick. Mr. Market was not just optimistic, he was completely unhinged, offering to buy any company with a .com in its name for a valuation that defied all logic and history. During this period, from roughly 1997 to early 2000, Warren Buffett became a figure of public ridicule. Berkshire Hathaway's stock, filled with old economy businesses like insurance, utilities, and consumer goods, was dramatically underperforming the soaring Nasdaq index. He was openly mocked in the financial press. Cover stories of major business magazines asked, "What's wrong, Warren?" He was called a dinosaur, a relic from a bygone era who just didn't get it. The pressure on him to abandon his value investing principles and join the party was immense. His own shareholders were questioning him. His performance was lagging badly. It would have been the easiest thing in the world for him to sprinkle a few tech stocks into Berkshire's portfolio, just to keep up appearances. But Buffett refused. His reasoning was simple and went right back to his core principles. It wasn't that he was anti-technology. It was that the tech companies of the day fell outside his circle of competence. He famously said he didn't want to play in a game where the other guy had the advantage. He could not, with any degree of certainty, project the earnings of these new companies out 10 or 20 years. He couldn't identify a durable competitive moat in a landscape that was changing by the second. And most importantly, the prices Mr. Market was quoting were so astronomical that they required heroic and often impossible assumptions about future growth to be justified. There was no margin of safety. In fact, there was the opposite, a margin of terror. So he patiently endured the criticism and the underperformance. He did nothing. In his 1999 letter to shareholders, written at the absolute peak of the frenzy, he calmly explained his position, writing, "The line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money." And then, in March of 2000, the bubble burst. The new paradigm was revealed to be the same old speculative mania that has appeared throughout financial history. The high-flying tech stocks collapsed. The Nasdaq, which had peaked above 5,000, would eventually fall by nearly 80% to below 200. Companies that had been worth billions of dollars went bankrupt. Trillions of dollars of speculative wealth were wiped out. The people who had piled in at the top, driven by greed and the fear of missing out, were financially and emotionally devastated. And Warren Buffett, the dinosaur, was proven to be the wisest man in the room. As the speculative stocks crashed, his portfolio of durable, profitable businesses held up remarkably well. Berkshire Hathaway's stock value soared relative to the market. His discipline had not just saved him from catastrophic losses, it had positioned him perfectly to be a provider of capital to a world that was suddenly desperate for it. His inaction, his refusal to follow Mr. Market's manic phase, was one of the greatest investment decisions of his career. It was a masterclass in the investor mindset, demonstrating that sometimes the most profitable action is no action at all. The underlying psychological principle at work during a bubble is a powerful cocktail of overconfidence bias and the bandwagon effect. Resisting euphoria requires a direct confrontation with these deeply ingrained human tendencies. Overconfidence bias is the tendency for people to have excessive confidence in their own abilities. In a bull market, especially a speculative one, this bias runs wild. When every stock you buy goes up, it's easy to start believing you're a genius. Your brain starts to attribute your success to your own skill, rather than to the simple fact that you're in the middle of a massive, indiscriminate bubble where everything is going up. This creates a dangerous feedback loop. Your success reinforces your overconfidence, which leads you to take even greater risks. You start to believe that you can't lose, that you have figured out the market. This is the psychological state that leads people to concentrate their entire life savings into a handful of speculative assets, or to start using leverage to magnify their genius. This individual overconfidence is then amplified by the bandwagon effect or herd mentality, which we discussed in the context of fear. In a bubble, the herd is euphoric. The social proof is all around you. Your friends, the media, financial gurus, everyone is celebrating the new era of permanent prosperity. The stories are not of loss and ruin, but of overnight fortunes and easy money. To not participate feels like you are actively choosing to be left behind. It triggers a profound fear of missing out, or FOMO. This social pressure is incredibly difficult to resist. The human brain is wired to seek consensus and to feel anxiety when it is out of step with the group. To be the person at the party saying, "I think this is unsustainable," while everyone else is getting rich, requires a level of emotional independence that very few people possess. It is this combination, your own overconfidence telling you you're a genius, and the herd telling you that you're a fool for not participating, that makes bubbles so irresistible and so destructive. The Mr. Market allegory is the perfect antidote because it provides an external, objective foil to this internal and social pressure. It personifies the euphoria as the ravings of a madman. When your friend tells you about the can't-miss tech stock they just bought, you can internally frame it as, "My friend is listening to a manic episode from Mr. Market." It depersonalizes the disagreement. You're not saying your friend is a fool, you're saying they are being seduced by a famously unreliable partner. This creates the psychological distance needed to maintain your own rational perspective. The allegory reminds you that the market's current enthusiasm is not a reflection of fundamental reality, but simply one end of a wild emotional spectrum. You know that the depressive phase is just as certain to arrive as the manic phase. This long-term perspective acts as a powerful sedative against the short-term frenzy. It helps you cultivate the patience and discipline to simply say no, to wait for a better pitch, a core principle of long-term investing. How does one build a practical blueprint for resisting the powerful pull of market euphoria? The process is a mirror image of the one for exploiting fear. It's about pre-commitment and discipline. The first step is to establish your selling criteria before you ever buy a stock. Most investors have a plan to buy, but no plan to sell. Your selling decisions should be based on business fundamentals, not on price action. You should write down the reasons you are buying a company and the conditions under which you would sell it. There are generally only 3 good reasons to sell a stock in the Buffett framework. First, you made a mistake in your original analysis, and the business is not as good as you thought it was. Second, the fundamental long-term prospects of the business have deteriorated. For example, its competitive moat is eroding. Third, the stock price has risen to a point where it is dramatically overvalued compared to your calculation of its intrinsic worth, and you have found a much better, more undervalued opportunity to reinvest the proceeds. Notice that the stock has gone up a lot is not by itself a reason to sell, and the stock has gone down is certainly not a reason to sell. By predefining your selling rules, you protect your future self from making emotional decisions in the heat of a manic market. The second step is to actively seek out contrary opinions and disconfirming evidence. When a market or a stock is hot, all the information you will encounter will be positive. This is called confirmation bias. To fight this, you must become a detective for the bearish case. If everyone is telling you a company is the next big thing, make it your mission to find the smartest people who are arguing the opposite. Read the short seller reports. Analyze the company's weaknesses. What could go wrong? How could this investment fail? This process, which Charlie Munger calls inverting, is a powerful antidote to overconfidence. It forces you to confront the risks and builds a more balanced and realistic view of the investment, making you far less likely to get swept up in the one-sided, euphoric narrative. A key part of a successful CEO mindset is to constantly challenge your own assumptions. The third step is to practice what Buffett calls inactivity bordering on sloth. In a euphoric market, the pressure to transact, to do something, is immense. Resisting this pressure is a superpower. You do not need to have an opinion on every hot stock. You do not need to participate in every trend. Your goal is not to catch every upward move in the market. Your goal is to compound your capital at a satisfactory rate over a very long period, with minimal risk of permanent loss. Often, the best course of action is to simply tend to your existing garden of high-quality businesses and ignore the noise of the casino next door. Having a deep-seated belief in the power of long-term compounding is the ultimate defense against the short-term temptations of speculative frenzy. This commitment to a long-term investing horizon is what separates true wealth creation from fleeting gambling wins. The antithesis, the path of the 99% during a bubble, is a story of greed turning into ashes. It begins with a casual flirtation with speculation. The investor hears about a friend who doubled their money on a hot stock. Intrigued, they dip a toe in, buying a small amount. The stock promptly goes up. The feeling is exhilarating. The effortless money is, as Buffett warned, a powerful sedative to rationality. Emboldened by this initial success and suffering from a severe case of overconfidence, they start to bet bigger. They sell their boring diversified index funds to concentrate their capital in the hottest sector of the market. They stop doing any fundamental research. Their entire due diligence consists of watching the price go up and reading bullish articles that confirm their bias. As the bubble inflates, their paper wealth skyrockets. They begin to mentally spend their new fortune. They brag to their friends. They feel like geniuses. This is the point of maximum risk, yet they feel completely invincible. They might even start using leverage, borrowing money to buy even more of the hot stocks, pouring gasoline on the fire. They are completely caught up in the herd, and the idea that this could end seems impossible. They ignore all the warning signs, the historically high valuations, the breathless media coverage, the cautionary tales from seasoned investors. Anyone who expresses skepticism is dismissed as a hater who doesn't get it. They have fused completely with the manic mood of Mr. Market. When the bubble finally pops, the initial drop is dismissed as a, quote, buying opportunity. They may even double down, a classic mistake of emotional investing. But as the decline accelerates, their paper fortune evaporates with terrifying speed. The euphoria is replaced by disbelief, then panic. The same person who refused to sell at the top, convinced the stock was going to the moon, is now desperate to sell at any price, to salvage what's left. They end up selling near the bottom, locking in devastating, often life-altering losses. The journey from euphoria to despair is complete. They are left not only with a decimated portfolio, but with a deep sense of shame and regret, vowing to never touch the stock market again. The financial connection of resisting euphoria is just as powerful as exploiting fear, though it manifests differently on your personal balance sheet. Its primary benefit is the prevention of catastrophic loss. The single most important rule of compounding is to never have to start over. A 50% loss requires a 100% gain to recover. A 75% loss, like the one suffered by the Nasdaq during the dot-com crash, requires a 300% gain just to get back to break-even. It can take a decade or more to recover from such a blow. By simply sidestepping these speculative manias, you protect your capital base, which is the engine of your long-term compounding. This is the ultimate form of risk management. It is the financial equivalent of the physician's oath. First, do no harm. Second, by not getting caught up in bubbles, you maintain your emotional and financial capacity to act when real opportunities arise. The investor who gets wiped out in a bubble is not in a position to take advantage of the subsequent crash. They are emotionally scarred and financially crippled. The disciplined investor, like Buffett in 2000, sits through the bubble with their capital and their sanity intact. When the crash comes, they are ready, willing, and able to deploy their capital at bargain prices. Resisting euphoria is therefore not just a defensive move, it is a critical offensive strategy. It ensures you will be the one with the cash when everyone else is desperate. Finally, this discipline instills a mindset that is crucial for long-term success in business and in life. It teaches you to differentiate between a trend and a fad, between signal and noise, between durable value and fleeting popularity. This ability to think independently and resist the pull of the crowd is a hallmark of great leadership and is central to any successful entrepreneurship journey. It allows you to focus your resources on what truly matters for the long term, rather than chasing short-term vanities. The financial reward for this discipline is not the quick, flashy gain, but the slow, steady, and unstoppable accumulation of wealth that comes from owning great businesses and letting them compound, uninterrupted by the manic depressive episodes of your partner, Mr. Market. We have now examined how to interact with Mr. Market at his emotional extremes, his depression and his mania. Our fourth pillar internalizes the conflict. It moves the battlefield from the external world of the market to the internal world of the investor's mind. This is the concept of the inward scorecard. Buffett has often said that the big question in life is whether you want to be the world's greatest lover and be known as the world's worst, or be the world's worst lover and be known as the world's greatest. It's a colorful way of asking a fundamental question. Do you judge yourself by your own internal standards or by the applause and judgment of the outside world? In investing, Mr. Market is the ultimate outer scorecard. He gives you a grade every second of every day. The inward scorecard investor learns to ignore that grade and judge themselves by their own, more meaningful metrics: the quality of their research, the soundness of their reasoning, and their adherence to their process. A powerful foundational anecdote illustrating Buffett's commitment to his inward scorecard comes from the very early days of his career, long before Berkshire Hathaway became a household name. In the late 1950s and 1960s, he was running the Buffett Partnership, a small investment fund for a close-knit group of family and friends in Omaha. From the very beginning, he set the terms of engagement with his partners in a way that was radically different from anyone else on Wall Street. In his annual letters, he didn't promise to beat the market every single year. He knew that was an impossible and foolish goal. Instead, he laid out a very specific, inwardly focused benchmark. His goal was to beat the Dow Jones Industrial Average, on average, over a long period. Specifically, he aimed to achieve a 10 percentage point advantage over the Dow's performance over rolling 3-year periods. He was setting up a long-term, process-oriented goal, not a short-term, outcome-oriented one. More importantly, he was brutally honest about the years when he would inevitably underperform. He explained to his partners that his conservative, value-oriented strategy would likely lag in rip-roaring bull markets. In those years, the outer scorecard, the daily comparison to hotshot fund managers and speculative stocks, would make him look foolish. He was preemptively telling his investors to ignore Mr. Market's judgment. He wrote, "I cannot promise results to partners. What I can and do promise is that our investments will be chosen on the basis of value, not popularity, that we will attempt to bring risk of permanent capital loss to an absolute minimum, and I will report to you exactly as I would wish you to report to me if our positions were reversed." He was asking them to judge him not by the quarterly performance but by his unwavering adherence to his stated principles. This was his inward scorecard. There was a period in the late 1960s when the market was in the midst of the go-go years, a speculative frenzy centered on conglomerate stocks and high-flying tech companies of the era. Much like the dot-com bubble 30 years later, it was a time when conservative value investing was out of fashion. Buffett's partnership, while still performing well, began to lag the dizzying returns being posted by the more speculative funds. The outer scorecard was flashing red. By the standards of Wall Street, he was falling behind. Many fund managers in his position would have felt immense pressure to change their style, to chase the hot stocks to keep up with the herd. But Buffett's anchor was his inward scorecard. He knew that the prices being paid for these go-go stocks were absurd and devoid of any margin of safety. He refused to participate in what he called the chain letter type of stock promotion. His commitment culminated in a stunning decision. In May of 1969, at the height of the bull market, he wrote a letter to his partners and liquidated the Buffett Partnership. He told them he could no longer find stocks that met his stringent value criteria. The market, in his view, had become too dangerous, too speculative. He said, "I am not attuned to this market environment, and I don't want to spoil a decent record by trying to play a game I don't understand." Think about the immense inner conviction this took. He was, in effect, closing down a phenomenally successful business because the external environment no longer allowed him to operate according to his internal principles. He chose to return his partners money, even though it meant foregoing the massive management fees he could have earned by just staying in the game. He judged himself not by his ability to gather assets, but by his ability to be a faithful steward of capital according to his own rules. A year later, the market crashed. The go-go years came to a screeching halt, and many of the hotshot managers who had made Buffett look timid were wiped out. His decision, which looked foolish by the outer scorecard of 1969, was proven to be an act of profound wisdom by the inward scorecard of history. The psychological principle underpinning the inward scorecard is the battle between an internal and external locus of control. This concept, developed by psychologist Julian Rotter, refers to the degree to which people believe they have control over the outcomes of events in their lives. People with a strong internal locus of control believe that they are primarily responsible for their own successes and failures. They focus on their own actions, decisions, and effort. People with a strong external locus of control believe that their lives are primarily controlled by outside forces, luck, fate, or other people. They are more passive and feel like victims of circumstance. In the world of investing, the outer scorecard investor has a profoundly external locus of control. Their sense of success or failure is entirely dependent on the whims of Mr. Market. When their stocks are up, they feel smart and successful because an external force has validated them. When their stocks are down, they feel like victims, betrayed by the market. This external dependency creates a state of constant emotional vulnerability. They are always reacting, never in control. Developing an inward scorecard is an act of seizing an internal locus of control in an environment that screams for an external one. It is the conscious decision to define success on your own terms. Instead of asking, "Did the market go up today?" the inward scorecard investor asks, "Did I follow my process today? Did I do my research thoroughly? Did I act rationally and avoid emotional decisions? Did I buy with a sufficient margin of safety?" The outcome, the daily price movement, becomes secondary to the quality of the process. This shift is psychologically liberating. It insulates you from the emotional roller coaster of the market because your self-worth is no longer tied to the random noise of the ticker. You can have a day where your portfolio is down 5%, yet feel successful because you know you made sound, well-reasoned decisions and did not panic. Conversely, you can have a day where your portfolio is up 5% on a speculative bet and feel like a failure because you know you violated your principles and simply got lucky. This is the mindset of a professional, whether in investing, entrepreneurship, or any other high-stakes field. It's about focusing on the things you can control, your research, your temperament, your process, and ignoring the things you can't, the market's daily mood. So how do you build and maintain your own inward scorecard? This is the blueprint for developing the psychological fortitude to judge yourself by your own standards. The first step is to create an investment policy statement, or a personal investing constitution. This is a written document that outlines your financial goals, your risk tolerance, your investment philosophy, and the specific rules and processes you will follow. It should detail your circle of competence, your criteria for buying a business, and your predefined reasons for selling. This document becomes your North Star. Writing it down is critical because it forces you to clarify your thinking and makes you accountable to your principles. When you are tempted to chase a hot stock or panic sell during a crash, you must consult your constitution. It is a letter from your rational, calm self to your future emotional, frantic self. The second step is to create a decision journal. For every single investment decision you make, every buy and every sell, you should write down the date, the thesis for the investment, the key metrics you used, your calculation of intrinsic value, the risks you see, and how you are feeling emotionally. This practice does two things. First, it forces a moment of deliberate, slow thinking before you act, which is a powerful antidote to impulsive, emotional decisions. Second, it creates an objective record of your thinking at the time of the decision. Months or years later, you can review your journal. If an investment worked out, was it because your thesis was correct, or were you just lucky? If it failed, was it a bad outcome from a good process, or was it a bad process from the beginning? This kind of structured self-reflection is the only way to truly learn and improve. It allows you to judge the quality of your decisions, not just their outcomes. This is the core of a genuine financial education. The third, and perhaps most difficult, step is to curate your information diet. The modern financial media is an outer scorecard machine. It is designed to create a sense of urgency, to provoke emotion, and to focus you on the short-term noise. To maintain an inward scorecard, you must aggressively tune this out. Stop watching the market all day. Delete the stock market app from your phone's home screen. Unfollow the short-term traders and pundits on social media. Instead, replace that fire hose of noise with a slow drip of wisdom. Read annual reports. Read business biographies. Read the classic books on value investing and behavioral finance. Your goal is to fill your mind with the long-term, time-tested principles of business and investing, not the ephemeral chatter of the daily market horse race. This deliberate curation of your inputs is essential for protecting your internal locus of control from the constant assault of external noise. The path of the 99% is to live and die by the outer scorecard. Their entire sense of self as an investor is tied to external validation. They chase hot fund managers who have had a good year, only to be disappointed when their performance reverts to the mean. They buy stocks that are popular and have good stories, mistaking popularity for quality. Their primary source of information is the financial news, and their main topic of conversation is the market's recent performance. They are obsessed with comparing their portfolio to their neighbors, to the S&P 500, to a random index on a daily or weekly basis. This constant comparison creates a perpetual state of anxiety and dissatisfaction. If their portfolio is lagging, they feel like failures. If it is outperforming, they feel a temporary fragile sense of superiority that is quickly shattered by the next market downturn. This mindset makes it impossible to be a true contrarian. They cannot buy a stock that is beaten down and unpopular, because the outer scorecard is telling them it's a loser. They cannot sit on cash during a bubble because the outer scorecard is telling them they are missing out. Their decisions are not driven by their own analysis, but by a desire to conform and to receive positive feedback from the herd and the market. This leads to the very behavior the Mr. Market allegory is meant to prevent: buying popular, expensive assets and selling unpopular, cheap ones. They are trapped in a feedback loop where their actions are dictated by the market's mood and their emotions are dictated by their actions, short-term results. It is a miserable and ultimately unprofitable way to invest, a surefire path to mediocrity, and a classic example of a flawed investor mindset. The direct financial connection of cultivating an inward scorecard is profound, though it is less about a single action and more about the long-term quality of all your actions. First, it enables true long-term thinking. By freeing yourself from the need for daily validation from the market, you give your investments the time they need to compound. The greatest fortunes are not made by trading in and out, but by owning wonderful businesses for many years. The inward scorecard provides the emotional patience required for this long-term investing approach to work its magic. It allows you to hold on through the inevitable periods of underperformance, secure in the knowledge that you own a great business, not just a fluctuating stock symbol. Second, it dramatically improves your decision-making process. By focusing on your process rather than the outcome, you are forced to become a more rigorous and honest analyst. The decision journal, for example, creates a feedback loop that highlights your biases and mistakes, allowing you to learn and adapt. This continuous improvement in your skill as an analyst and capital allocator will, over time, inevitably lead to better financial results. It transforms investing from a game of luck into a craft that can be honed and perfected. Finally, the inward scorecard significantly reduces the behavior gap, the well-documented phenomenon where investors' actual returns are far lower than the returns of the funds they invest in. This gap is caused entirely by bad behavior, chasing performance, panic selling, and emotional trading. By adopting an inward scorecard, you immunize yourself against these wealth-destroying behaviors. You are less likely to buy at the top, less likely to sell at the bottom, and less likely to churn your account. Simply by avoiding the major errors that plague the outer scorecard investor, you place yourself in the top echelon of financial performers. your portfolio's returns will more closely mirror the returns of the underlying businesses you own, which is the entire goal of value investing. You stop being your own worst enemy, and that, in finance, is more than half the battle. This brings us to our fifth and final pillar, a concept that is the quiet, unseen partner to all the others: the power of inaction. In a world that glorifies action, speed, and constant engagement, the idea that the most profitable move is often no move at all is deeply counterintuitive. Mr. Market makes you an offer every single day. The most powerful choice an investor has, and the one they use most rarely, is the choice to say no thank you. This pillar is about the immense, hidden advantage of patience, of waiting for the truly great opportunity, the fat pitch, and resisting the urge to swing at every ball that comes over the plate. The foundational anecdote that perfectly encapsulates this principle is Buffett's acquisition of See's Candies in 1972. This transaction is legendary within the Berkshire Hathaway story, not just for its incredible financial success, but because it marked a pivotal shift in Buffett's entire investment philosophy. It was the moment he moved from buying cigar butts, fair companies at wonderful prices, to buying wonderful companies at fair prices, a lesson he famously learned from his partner, Charlie Munger. The story begins when Blue Chip Stamps, a company that Buffett and Munger controlled, was presented with the opportunity to buy See's Candies, a beloved family-owned chocolate company based in California. See's was a fantastic business. It had a brand that commanded intense customer loyalty. It had pricing power. It could raise prices every year without losing customers, and it required very little capital to operate. Buffett was immediately interested, but there was a problem. The See family was asking for $30 million for the business. Buffett, still deeply rooted in his cigar butt methodology of buying things for far less than their tangible asset value, did a quick calculation. The company had about $8 million in tangible assets. Buffett's initial offer was $25 million, and he refused to go any higher. In his mind, paying a premium of more than 3 times the book value was speculative. The deal almost fell apart. It was Charlie Munger who convinced Buffett to change his mind. Munger argued that they were not just buying the tangible assets, they were buying the intangible asset of the brand, the moat, that allowed See's to generate incredible returns on capital. He convinced Buffett that it was better to pay a fair price for a truly wonderful business than a bargain price for a mediocre one. Reluctantly, Buffett agreed to the $30 million price tag. They closed the deal. The initial investment was $25 million. That $25 million purchase has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which was sent to Omaha for Buffett to reinvest, without requiring any significant additional capital investment in the candy business itself. It was, as Buffett has called it, quote, the prototype of a dream business. But the key lesson here is not just about buying quality. It's about what Buffett did just after he bought it. He did nothing. He owned it. He held it. For 50 years. He resisted any temptation to sell it when other businesses were hotter. He didn't try to trade up. He simply let this wonderful business do what wonderful businesses do: compound value for its owners year after year after year. This story contrasts sharply with the hyperactive world of Wall Street. A private equity firm, for example, might have bought See's, loaded it with debt, cut costs to the bone to boost short-term earnings, and then flipped it a few years later. Buffett's approach was the opposite. He recognized he had found a true gem, and his most intelligent course of action was to get out of the way and let it shine. His inaction was his genius. This is the ultimate expression of the Mr. Market allegory. Every day for 50 years, Mr. Market has quoted Buffett a price for See's Candies. Some days that price might have seemed ridiculously high. But Buffett knew that the value of holding this compounding machine for the long term was far greater than any short-term price he could get for it. His patience, his willingness to do nothing, is the secret sauce that turned a $25 million investment into a multi-billion-dollar gusher of cash. The psychological principle that makes inaction so difficult is the action bias. This is our innate tendency to favor action over inaction, even when inaction is the more rational course. In our evolutionary history, this made sense. If you heard a rustle in the bushes, it was safer to act, run, than to do nothing and analyze the situation. In the modern world, and especially in investing, this bias is a liability. The entire financial industry is built to exploit your action bias. Don't just sit there, do something, is the implicit message of every trading platform, every market update, every piece of financial news. The constant stream of information and the ability to trade with a single click creates a powerful illusion that you should always be doing something, buying, selling, rebalancing, optimizing. This bias leads to overtrading, which is a proven destroyer of returns due to taxes and commissions. The Mr. Market allegory directly counters this bias. It teaches you that your partner's daily offers are mostly noise. You are under no obligation to act on any of them. By framing the choice as simply accepting or rejecting a daily offer from an unreliable partner, it makes doing nothing the default, sensible option. The burden of proof is on the action, not the inaction. This reframing is critical. Instead of asking, "What should I do today?" you learn to ask, "Is today's offer from Mr. Market so extraordinarily compelling that it justifies the costs and risks of taking action?" Most days, the answer will be a resounding no. This mindset is what allows Buffett to sit for years, sometimes accumulating cash and waiting for that fat pitch, the rare, obvious, high-probability opportunity. As the legendary baseball player Ted Williams explained in his book The Story of My Life, the key to his success was not swinging at every pitch, but waiting for a pitch in his sweet spot. An investor's job is the same, with one crucial advantage. In investing, there are no called strikes. You can wait forever for the perfect pitch without penalty. The action bias makes us feel like we have to swing at everything. The Mr. Market framework gives us the patience to wait for the home run opportunity. The blueprint for cultivating the power of inaction is a simple three-step process for slowing down your decision-making and embracing patience. The first step is to schedule your financial life. Instead of reacting to the market's daily whims, you should operate on a predetermined, long-term calendar. For example, decide that you will only review your portfolio in detail once every quarter. Decide that you will only consider making new investments when you have new capital to deploy or during specific, pre-planned times of the year. This removes the temptation to constantly tinker. By putting your investment process on a slow, deliberate schedule, you break the cycle of reactive, emotional decision-making promoted by the high-frequency noise of the market. You are imposing a system of forced patience on yourself. The second step is to build a cooling-off period into your decision-making process. For any new investment you are considering, impose a mandatory waiting period. For example, once you have completed your research and decided you want to buy a stock, force yourself to wait 48 hours before placing the trade. This simple delay allows the initial excitement or greed to fade and gives your rational, analytical brain time to do a final review. You will be surprised how many brilliant ideas seem less compelling after 2 days of quiet reflection. This acts as a circuit breaker for the action bias, ensuring that your decisions are born from conviction, not from impulse. The third step is to measure your success not by the frequency of your activity, but by the long-term performance of the businesses you own. Shift your focus from the stock prices to the underlying business results. Once a quarter, when the companies you own report their earnings, spend your time reading their reports and assessing their operational progress. Are they gaining market share? Are their profit margins improving? Are they allocating capital intelligently? By focusing on the slow, steady progress of the actual businesses, you will become far less concerned with the frantic, meaningless gyrations of their stock prices. You will start to see yourself as a long-term business owner, not a short-term stock trader. This perspective is the ultimate source of patience. and the foundation of any successful long-term investing strategy. The antithesis is the path of the hyperactive trader, the person who is a slave to their action bias. They believe that the key to success is to be constantly busy. They are glued to their screens from market open to market close, chasing small price movements. Their portfolio is in a constant state of churn. They buy a stock because it's breaking out and sell it a few days later because its momentum has stalled. They have no deep understanding of any of the companies they trade. They are merely renting ticker symbols. They are often experts in technical analysis, believing they can predict the future by reading patterns in a price chart, a practice Buffett and Munger have openly ridiculed. They pay a fortune in commissions and short-term capital gains taxes, a constant drain on their returns that they often ignore. Their investment journey is one of frantic activity that leads nowhere, like a hamster running on a wheel. They mistake the adrenaline of action for the satisfaction of progress. They are playing Mr. Market's game on Mr. Market's terms, a game that is almost impossible for an amateur to win against the high-frequency trading algorithms and institutional players that dominate the short-term landscape. It is a path of high stress, high costs, and ultimately high rates of failure. The direct financial connection of mastering inaction is one of the most powerful but least appreciated forces in wealth creation. The primary benefit is the dramatic reduction of frictional costs. Every time you trade, you incur costs, commissions, bid-ask spreads, and most importantly, taxes. Short-term capital gains are taxed at a much higher rate than long-term gains. The hyperactive trader is handing over a huge slice of any potential winnings to their broker and the government. The patient, inactive investor who holds a stock for many years allows their capital to compound tax-deferred. The difference this makes over an investment lifetime is staggering. It is a massive, structural advantage that the inactive investor has over the active one. Second, the power of inaction allows you to fully harness the miracle of compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world. But compounding needs one crucial ingredient: time. By constantly trading, you are interrupting the compounding process. You are pulling up your plants every day to see if the roots are growing. The long-term holder plants a seed in a fertile field and lets it grow into a mighty tree. The returns from a single great business, held for decades, can be so immense that they can fund an entire retirement or build a dynasty. The key is to buy it and then let the magic of compounding do the heavy lifting. Finally, a commitment to inaction preserves your most valuable asset, your mental and emotional capital. Chasing the market day in and day out is exhausting and stressful. It consumes your time and energy, pulling you away from your career, your family, and your passions. A patient, long-term approach frees you from this burden. It allows investing to be a calm, background process that supports your life, rather than a frantic central obsession that consumes it. This peace of mind dividend, while not visible on a balance sheet, is one of the greatest returns a rational investment philosophy can provide. It is the final and perhaps most important reward for learning to simply say no to the daily madness of Mr. Market. You have just spent this time absorbing a complete system of thought. This wasn't just a list of tips. It was the installation of a new mental operating system designed to manage the most powerful and dangerous force in your financial life, your own emotions. You now possess the mental framework that separates the professional from the amateur. You understand that the market is not a source of wisdom but a bipolar business partner named Mr. Market. You have learned how to separate his frantic price from a company's true value. You have a blueprint for exploiting his fear and a discipline for resisting his euphoria. You have been given the tools to build an inward scorecard, freeing you from the tyranny of outside opinion, and you have discovered the hidden, immense power of patient inaction. This is the foundation of a rational mind in an irrational world. But mastering the parable of Mr. Market, as powerful as it is only the first layer of the deep, interconnected system of mental models that Warren Buffett and Charlie Munger use to navigate the complexities of business and life. This model is a shield, designed to protect you from the market's emotional chaos. But what about the tools you need to go on the offensive? How do you analyze a business and identify the truly great ones? The ones with the durable competitive advantages, the moats, that are worth holding for a lifetime? How do you assess the quality of management? How do you think about allocating capital not just in the market but in your own business or your own career? The Mr. Market framework tells you when to act, but the other models tell you what to act upon. You have just mastered one crucial piece of the map, but there are other, equally powerful pieces waiting to be connected. The video that is now appearing on your screen is not a random suggestion, it is the next link in that chain. It is the piece of the map that connects the psychological discipline you've just built to the analytical tools required for world-class decision-making. Think of what you've just learned as the unshakable foundation of a skyscraper. The video on your screen is the blueprint for the first 10 floors. It is the logical next step, the missing link that will take the defensive power of the Mr. Market model and fuse it with the offensive power of business analysis. The choice you face is not simply whether to watch another video. It is a choice about the kind of decision maker you intend to become. Are you content with a shield, or do you want to complete your arsenal? The journey to mastering this system of thought is a commitment. The click you are about to make is the next step in that commitment, a declaration that you are serious about continuing your ascent. Complete the map.